On February 28, 2026, the United States and Israel launched strikes on Iran. Within 72 hours, oil crossed $100 a barrel for the first time since 2022. Within a week, it hit $120. Gas prices in the US jumped 80 cents in a single month. Diesel crossed $5 a gallon. And the IEA, the International Energy Agency, called it the greatest global energy security challenge in history. But here's what nobody is explaining to you. This war isn't just about missiles and politics. It's about a 21-mile wide waterway that controls 20% of all the oil on the planet. And right now, that waterway is closed. This isn't a risk. This isn't a maybe. It's already happening, and it's coming for your wallet. Let's start with the basics, because if you don't understand what the Strait of Hormuz is, none of what's happening makes sense. Imagine a corridor of water, 21 miles wide at its narrowest point. That's about the distance from Manhattan to the middle of New Jersey. Now imagine that through that corridor, every single day, flows 20 million barrels of oil. That's roughly 20% of all the oil consumed on Earth. Saudi Arabia's oil, UAE's oil, Kuwait's oil, Iraq's oil, Qatar's gas. All of it goes through this corridor to reach the rest of the world. There is no meaningful alternative. There are some pipelines, but they can handle maybe 4 or 5 million barrels a day at best. The rest? If Hormuz closes, it doesn't move. And on March 2nd, 2026, an Iranian IRGC official announced 3 words that sent shockwaves through every financial market on the planet. The strait is closed. Since then, tanker traffic has dropped by 70%. Over 150 ships are sitting anchored outside, waiting. Gulf producers, Iraq, Kuwait, Saudi Arabia, have already cut production by at least 10 million barrels per day. Because when you can't export, you can't keep producing. Storage fills up. Wells have to shut down. The IEA says this is the largest oil supply disruption in the history of the global oil market, ever. Bigger than 1973. Bigger than 1979. Bigger than anything we've seen before. Now let's talk about what this actually means for you. Not for traders, not for governments, for you. Before the war started, Brent crude oil was trading at around $70 a barrel. On March 8th, it hit $120. That's a 70% increase in 8 days. Now, you might think, so what? I don't buy barrels of crude oil. And you're right, you don't. But you buy everything that depends on it. Gasoline, diesel, heating oil, jet fuel. The average US gas price has already jumped 80 cents per gallon in a month. Diesel, which trucks use to deliver literally everything you buy, crossed $5 a gallon. And here's where it gets personal. Every single product in every single store you walk into was transported by a truck running on diesel. Your food, your clothes, your phone, your medication. When diesel costs more, everything costs more. That's not speculation, that's arithmetic. A Virginia Tech economist put it bluntly. The Fed cannot simultaneously fight supply-driven inflation and support growth with a single interest rate instrument. Translation: the people in charge of protecting your economy are stuck. They can raise rates to fight inflation, but that crashes the economy. They can lower rates to protect growth, but inflation explodes. There is no good option here, and you're caught in the middle. But oil is only half the story, because the Strait of Hormuz doesn't just carry oil. It also carries 20% of all the world's LNG, liquefied natural gas. And most of that LNG comes from one place, Qatar. Before the war, Qatar was sending massive amounts of natural gas to Europe and Asia. That flow has now stopped. For Europe, the timing couldn't be worse. Coming out of a harsh winter, European gas storage was already at just 30% capacity. That's historically low. And now, the supply they were counting on to refill that storage, gone. Dutch TTF gas prices, the European benchmark, nearly doubled in March. The European Central Bank has already postponed its planned interest rate cuts. UK inflation is now expected to breach 5% in 2026. And here's the chain reaction. Higher energy prices lead to higher manufacturing costs. Higher manufacturing costs lead to higher prices for every good Europe exports. If you're in the UK, Australia, or Canada, and you import anything from Europe, which you do, this affects you directly. Germany, France, the UK. Their industrial manufacturers are already imposing surcharges of up to 30% to offset surging electricity costs. Those surcharges don't disappear, they get passed to you. Now let's talk about the part of this story that almost nobody in Western media is covering properly. 84% of the oil that normally flows through Hormuz goes to Asia. China gets a third of its entire oil supply through that strait. Japan, South Korea, India. All of them. These are the world's manufacturing engines. If their energy supply is disrupted, manufacturing slows. If manufacturing slows, the products they make become scarce and more expensive. iPhones, cars, electronics, everything made in Asia. China already has about 1 billion barrels in oil reserves, roughly a few months of supply. But if this drags on past summer, those reserves start running out. And when China runs out of cheap oil, the price of everything made in China goes up. India is in a particularly difficult position. The US Treasury had to give India an emergency 30-day waiver just to allow them to buy stranded Russian oil to stabilize fuel prices. 220,000 Indian nationals have already been evacuated from the Gulf region. When the world's largest democracy needs emergency waivers just to buy oil, you know this situation is serious. So what's happening to your investments? On March 2nd, the day the strait was officially declared closed, the Dow Jones dropped over 400 points. The S&P 500 fell 0.7% in a single session. The Nikkei in Japan dropped 7% in a single morning. South Korea's Kosdaq fell 7.8%. Taiwan's index dropped 5.8%. This is what economists call a supply shock. It's different from a regular market correction. In a normal correction, you wait it out. Markets recover. But a supply shock means the underlying economy has actually changed. Costs are higher, permanently, until the supply problem is solved. And here's the cruel irony. The solution requires the war to end and Hormuz to reopen. But the US and Iran are still exchanging military strikes as we record this. Nobody knows when this ends. The IEA released 400 million barrels from emergency reserves. Sounds like a lot. At current global consumption of 105 million barrels per day, that's less than 4 days of supply. It calms the panic for a week. It doesn't fix anything. So let's bring this back to you. What does all of this actually mean for your life? Your energy bills are going up. Not maybe, not possibly. They are going up. Gas, electricity, heating, all of it tied to this disruption. Inflation is coming back. Supply shocks always cause inflation. Every single one in history. The 1970s oil crisis, the 2022 Russia-Ukraine shock. This one will be no different. And by the IEA's own assessment, this one is bigger than all of them. Your central bank is stuck. The Fed, the Bank of England, the ECB. None of them can fix a supply problem with interest rates. They will have to choose between inflation and recession. And historically, they always choose wrong. This is not over. The US military only began trying to reopen the strait on March 19th. Negotiations are stalled. Iran says there's nothing to negotiate. Every day the strait stays closed, the damage compounds. The question isn't whether this war affects your economy. It already has. The question is, how prepared are you for what comes next? In the next video, we're covering exactly that. The 5 assets that historically survive an oil shock like this. What you should be doing with your money right now. And what history says happens in the months after a supply crisis of this size. Subscribe, because what's coming next is not something you want to miss.